So these things have been already, yeah. So as has been already highlighted by Ashish, some of the statements are forward-looking statements. These should not be construed as an investment advice, uh, uh, and the confidentiality should be maintained. I would like to spend a few minutes talking about our results for the last financial year. For the few folks uninitiated, I would just like to remind that in February 2025 last year, uh, we went through a Baxon event wherein 65% of the sales were just coming through Amazon, and Amazon stopped selling refurbished goods, and it had a major impact on the company as such as like it has a significant impact in terms of overall 65% of our revenues getting shut down overnight as such. In terms of this year was largely a year of consolidation and reorientation. We doubled down on our own channels. That includes our website and also our efforts towards enterprise sales, including SMEs, large corporates, and education as a sector. In terms of year on year, we saw a drop in our top line from 65 CR in FY25 to 40 CR. However, we were able to maintain the similar gross margins in spite of radical change in the overall business models that we have implemented in last year. We have so last year we have so this year we have booked an overall write-off of one-time write-off of approximately 13.85 CR. We will look deeper into this, like what are the various contributions, what are the factors that are contributing to the same as such. In terms of overall unit sales, our average selling price has actually improved on a year-on-year basis as we migrate from focusing only on the retail customers to also enterprise sales as such, which we strongly believe in the long term will help us to improve our margins. Key things I want to call out, as you can see it on the screen, is the breakup of our P&L. So key thing I want to call out is if we exclude our extraordinary items, uh, we had a negative EBITDA of around 6% cumulatively for FY26. Largely, it remained flat for the first and the second half. How right? So though overall, so that largely translates into that in terms of cash burn, there was an approximate cash burn of approximately 2.35 CR for the last year, right? Now looking at the various other items or the extraordinary items where we have taken like one-time write-offs, it has been mostly driven by, so we have taken an inventory write-off of approximately 12.38 CR. We will look at the components of the same and the factors that are driving this. Besides that, an ESOP outflow of 1.85 CR, which has been pre-planned as has been already allocated to the leadership, is included in the overall uh, uh, losses or the extraordinary items, and 4.22 CR of depreciation on the fixed assets that we have is included in the same. So key point we want to highlight here is in terms of cash flow, yes, there we were at a negative 6% as such. So that definitely shows that in terms of inherent business, and if you look at the gross margins, right, we continue to maintain those gross margins. So the two things, like one is definitely the one-time hit that we have taken in the last year, right? And of course, the fixed component of the overall, I would say P&L that will continue to reduce as we scale the business, and hence we will be able to reach to the older EBITDA levels as such. This slide gives you an insight into the inventory write-off that we have taken and the factors and the key, I would say, the categorization of the various aspects. Right? So there were three driving factors for the same, right? One, so the first one, it was an amalgamation of, I would say, switching off of the Amazon, like as a channel, right? And also migration. So Windows, Microsoft has now stopped supporting Windows 10 and have said that the support for Windows 10 and this communication came in last year around June. Right? So Windows 10 has been demised and only Windows 11 and forward, like systems will be supported. What did that meant for us is that any inventory which was older than the eighth generation, in a way, we saw a demand dip because of two factors. One, Microsoft pulling back uh, on the support for Windows 10 and earlier versions. And also because of the Amazon channel, we were able to liquidate these low-end inventories. And definitely through our channel, where the client profile seems to be much more tier one and tier two centric, there were challenges in liquidating these inventory, right? So as you see on the right side table, which is there, right? So this constituted approximately 21% of the write-off that we took on our books. These were the older inventories which were there with us, right? And just to add to the same, like the fact also is the fact that like we were at running almost at a 5 CR kind of a run rate when Amazon was there, and then the run rate reduced to 1.8 CR. That's like 40% of the number, right? So definitely we had a good inventory to support that kind of a growth at that time, right? And of course, we had a buildup of slightly older generation inventories also that we cautiously took a call and liquidated at a lower price point to ensure that we have sufficient liquidity in the system and our like cash is not stuck in the inventory as such. Second, as I've already covered, exit of the major market place, which is like Amazon. And third key factor is all the spares and the components, right? For example, DDR3 RAMs, hard disks, and also the spares which were associated with these older generations, right? We did a complete like an inventory, so like we liquidated a lot of those, right? Literally pretty much at a scrap value or like 10% of the values, and also written down the spares, the 10% of the spares that we continue to hold. But we have written down the values, assuming because these are fairly old. So these are the three key factors because of which we did a comprehensive inventory audit and took a one-time write-off on our inventory positions as such. Moving on. So this is just to like share with you in terms of revenue growth, right? And also to like highlight a bit on in terms of what are the P&L contribution factors there. On your left-hand side on the screen, you will see our H2 FY25 overall revenue, right? And the breakup of the same. The orange big bar that you see was predominantly your Amazon revenue, which, as we just discussed, right, got wiped out. Having said that, if you look at the other contributing channels, which includes our own website, business, and education vertical as such, right? So on an comparing it from a month-on-month starting of FY 25-26 to the end of 25-26, overall we have seen a 225% growth on our own channels. So in a way, that's we have been able to reorient ourselves and rebuild very in pretty dynamic fashion our business and education channels and also doubled on our own website as such and have been pretty much been delivered 200% growth on a year-on-year basis as such. And we are very confident that now it really puts us in a position there, like it's kind of like the worst is over and we are like well positioned in terms of building upwards from here and coming into positive territories as such. Right? So the metrics which you see in your right hand side, it gives you a flavor of how the last 3 months, right, or 4 5 months have been trending for us. You can see on the top the sales numbers, right? So they have been steadily in the growth path, right? Of course, in February, March, you see a steep jump from 2.8 to 3.7, 3.9. That was also attributed to two large enterprise orders. However, you can see there is a very democratic, like a trend that we continue to see with the revenue run rate increasing from 2.8 to now approximately 3.7 to 3.6 in just a span of 5 to 6 months. Key things I want to highlight with the group is if you look at the variable component of the cost structure and the fixed component of the cost structure, right? So it's the fixed component of the cost structure largely driven by two aspects. One is our fixed investment, right? For example, the facility that we have can support on a monthly basis 15,000 units production. Currently, when the Amazon drop happened, we dropped to approximately 1,500 units. Now we have been able to bring it back to 300, 3,500 units, right? So there are two parts to this fixed component, the capital expenditure and the facility that we have. The second is, of course, the employee, like the leadership and the fixed component of the employee. So these two put together, like as the overall number of units and the sales continue to grow, their contributions, right? So in a steady state, our assumption is that this particular fixed component, right, which includes the management overhead and the capital expenditure, should stabilize around 7 to 8%. The fact that it remained approximately 15% for the last full year, it was approximately 20%, is the reason for a negative EBITDA. And we are already in positive territory for the last 2 to 3 months as such. And as the volumes continue to grow, we are pretty confident that we will be back in track in like as the things were before the last year as such. Um, this is just a very high level snapshot. Two key three things I want to share with the group before like getting right. So in terms of demand, right, or all our three channels, we continue to see strong demand building up. Be it our like own website and also the demand from the enterprise segment. I attribute this to 2 to 3 levers. First, largely being that the RAM SSD. So in general, the hardware costs have increased by 30 to 40%. So in general, overall market is extremely receptive right now to refurbished product, both from the price point perspective, and that's the reason one. Second, as we said, right? So I think last year we pivoted on sales to the enterprise segment, and definitely we have built a very strong team. Our conversion ratios continue to be very, very strong in terms of discussions to closure and the interest being generated. Our customer retention when it comes to enterprise customers is at almost 80% right now, right? The fact that it took us time because we have to build this channel ground up and it does take team, but so the overall pipelines, the robust pipeline and the demand that we see can be attributed to these two significant levers. One are the macroeconomic in nature, being driven by the market. Second, being the reorientation of the team and us building an enterprise team internally and reaching out to the customer. What you can see on the screen is a snapshot of a strong pipeline, which is already building with us. We have got even among the Fortune, like I would say the top 100 companies in India, we have at least 15 of them transacting with us now. So that's a great, like good validation of the product quality that we are able to deliver. And we are very sure that this kind of a retail like business will help us to build on this the kind of a pipeline that we have, right? Yeah. So I mean, you can see it on the screen. So the pretty like good pipeline that we have built as such. These are a couple of the other initiatives and the focus for this year, right? So of course, we doubled down our D2C digital channel. Our marketing spends increased initially, because we have to build that visibility with the end customers, right? We have already surpassed 1 million monthly visits. Our conversion rates and the ROAS, which is like, like the amount used for like COA, right? Cost of acquisition. I personally believe they continue to be like industry leading as such, right? So we are seeing like very good like returns on the investments that we continue to make on our own digital channel, both in terms of acquiring the traffic, right, and being able to convert that in terms of sales. Of course, we continue to add more value-added services for our end customers, starting from buyback of the end of the life devices to providing refurbishing as a service and other aspects. Um, we completed, there were two formalities remaining with respect to R2V3 certification, which is an internal certification, international certification. We completed that in the last year. That definitely gives us a lot of leverage in terms of being able to work with OEMs directly, because that's one of the preconditions to work with OEMs directly. I discussed about like B2B channels, which is on your right top side, right? So yes, I mean we are seeing some like good traction coming from the various large corporates in the various verticals where they can see the value proposition and are willing to sign up long-term contracts also with us. Um, we are also working on distribution partnerships, right, and continue to focus on the cost and the operations optimizations as such, right? So we almost did a 46% of headcount rationalization at the start of the last financial year. Of course, it took us a quarter to be able to implement that because of the various regulations, right? And for the last one quarter, we are again back on a hiring track and building back the team as the volumes continue to grow for us. Um, yeah, so this is just to like call out the key challenges that we faced and our responses for the same. So as we discussed, the first big challenge was like Amazon getting out of the refurbished business. And as we looked at it as an opportunity in terms of building an alternative platform. And if I look at it in terms of growth, I think we have been able to, I would say that at least been able to get 50 to 60% of our retail sales, which we are getting from Amazon, from our website itself now, right? So that channel continues to be like bear fruits and position us as an alternative platform when it comes to this. Right? And of course, enterprise solutions. So we have been able to build basis the specific requirement for each and every enterprise, be it in terms of warranty conditions, be it in terms of financing, be it in terms of the configuration modifications, so on and so forth. And of course, we had a huge cost overhead because we have projected our financial growth and built the capex as per the same, right? And we took the required requisite actions appropriately on time to reduce our variable costs at the start of the year to be able to conserve the cash and rebuild the new sales channel, right? And we so that we have the cash in place at the time of growth. This is how the balance sheet position looks like as of now. Key thing I want to call out is that as a company, I think like last year our key focus was as we reorient and redesign our sales channel to conserve cash so that we have sufficient ammunition when the growth phase comes, right? So we have reasonably okay cash position of 15 CR as of now, and so which we feel puts us in a good position now in terms of uh, like spending on the growth as we continue to grow in these channels. So with this, I mean the update from my end comes to a closure, and we'll open the forum for a Q&A.
Yeah. Thank you so much, Vishesh. So we'll just open the floor for the Q&A session. So I'll request everyone to raise their hands first and introduce while before just asking questions about themselves. Yeah, thank you. So first question, Vishesh, is coming from Sachin Sehrawat. Sachin Sehrawat, I'm just unmute you. Kindly proceed.
Good morning, sir. I'm Sachin. Can you hear me, sir?
Good morning, Sachin. Yes, I can hear you. Good morning, Sachin.
Sir, in a last con call in November 25, we said that we are seeing an uptick in the monthly sales run rate. And also, we are increasing our employees to scale up the production. And we were planning that within a year, we will reach at our peak levels of sale run rate. So now, with half of the year ending, we can see the industry of refurbished laptops and desktop is growing at 50% year on year, like GNG Electronics and EPW India. These are the listed companies. So my question to you is, what went wrong with Newjaisa that we are degrowing with respect to the last 6 months instead of at least following the industry standard?
So last 6 months, largely our online channel grew at almost approximately like pretty much remained. So H1 to H2 comparison, right? So our
Yes, sir.
like retail channel pretty much or the online channel remained flat, right? And there was so just to add, like in the H1 we had a one-time transaction because we did a mobile transaction, right? In H1 that was approximately of 2 CR, right? Okay. So I
Mhm.
mean, if I take that out, we approximately, yes, I mean, as you said, we didn't double definitely, right? We saw an approximately like an 10% kind of a growth on a H1 to H2 basis. Right? In terms of, yes, I mean, it was definitely not like doubling of on a like H1 to H2 basis, but it has been on a positive trend line as such, right? So yes, that one-time transaction of like 2 CR with mobile, it does look like kind of a degrowth, but in our core business as a PC, we have like grown by approximately 10%. And for us, I think, yes, I mean, because we are rebuilding these channels, right? So we were online only earlier. So it definitely took us a while to streamline our online enterprise businesses. But now we are definitely like seeing a reasonable growth coming in these particular channels.
Okay, sir. My second question is, sir, after 12.5 CR of inventory write-off, can we expect the balance sheet to be cleaner now? And are there such more dead inventory in the stock to be written off at present?
So yeah, good question. I think so. Besides the inventory write-off, we have definitely strengthened or like put more checks and balances in place, right? To make sure, like so for example, we are now getting like every quarterly and external inventory valuation done, right? So that like we have like a right valuations in like place. So in terms of what inventory we are holding right now, we feel like the past is like done in that regard, right? And we have like now like the proper aging and budgeting being put in place, right, to make sure that the right control measures are in place and are well evaluated every like quarterly. And in case there is any major aging happening, so we appropriately devalue like that. So most of the inventories we took this in a way, like an year where we like critically look at the aging ones, and if because of the revenues have dropped, right, we took the right like hit in terms of inventory. So I do not envisage that to like any more of the aging inventory to be there.
Sir. So my last question, sir, with the company running in losses, may I know what is the plan for top management remuneration compensation for the next year? Matlab, are we planning to increase or decrease that compensation part of top management?
So as of now, like our top management remuneration, right, has been like pretty modest. I think the key personal remuneration is published if I'm not wrong, right? So that continues to be modest, and we are not looking at a significant increase in the same. Right? Having said that, I think three or four key positions as we have to like to build on the new channels, right? Of course, those remain flat, right? So we expect the leadership to continue to remain flat in that sense, but that was required to be in place to build these channels, right? So as I said, I think right now, if you look at not only like the leadership or the like the key management compensation, but also the support functions that includes your finance, ITM, IS, marketing, right? All of those cumulatively add up to approximately 7% of the top line, right? 7 to 8%. And now that the revenue has started like building up, so their overall contribution to P&L will continue. So we are not expecting any significant increase as such on the leadership. And we personally believe that we are not, like it's like over like or they are on a higher levels as such.
Right. So thank you so much.
Yeah. Uh, yeah. So, Uh, please kindly raise a hand. So I don't see anyone has raised their hand. If anyone has any other questions, kindly raise your hand and unmute yourself and please proceed to ask a question.
I don't think there are more questions.
If we don't, okay. So the next
Yes.
question is coming from Bijil Shah, Mr. Bijil Shah. Uh, so kindly unmute yourself and please ask your question.
Yeah, hi. Thanks for the opportunity. Can you give us some details of inventory of 26 crore rupees? So how much is 10 generation and before? What is the value of that inventory in 26 crore?
No. So I think by generation, I will not be able to like give you offhand, right? And Ashish, if you can, I think we have done by aging, right?
Yes.
So Ashish, if you can like share by aging of the inventory, and
No, but I mean, the generation part is very important, no, because they are not supporting anything before 10th generation. So that is the most critical point
no,
that
no, eighth
we
generation,
need
yeah,
to understand the inventory.
yeah. So that
Yeah, okay. So,
bifurcation I can share, Vijay, right? So
yeah, sorry, the 8th generation.
yeah, yeah. So eighth and beyond is supported, right? So largely right now, 85% of the inventory is eighth and above, right? Okay. We still have around 10 to 15% like below, but like there's,
So
I mean
your
that
that does
is the
not
what.
tally with your, I mean, whatever data you have given on the presentation. So there is a write-off of around 2 crore, which is, I think you have written it is 20% on the machines, laptops, and all, which was probably, I mean, another column said it is 20%. I assume it is 20%. So then 80% of that is still in your inventory. So around 10 crore kind of amount. I mean, it looks like from the presentation which you have given, 10 crore is kind of before 8th generation. Can you put this number in black and white, not like what 85 and 10 and 15% exact number, if you can put, that will be really helpful. And as you are saying that there is already somebody who is valuing, then of course he would have valued every piece of the inventory, then that should be readily available.
Yes, I mean, I don't see when so right now 15% as per in terms of quantity, right? Okay, is below eighth generation, right? In terms of value, of course, it's going to be way lower, right? Because the value of that is way lower. So I'm talking about in terms of quantity. In terms of value, so we have by aging.
No,
Ashish,
can
do
you
you
just go
have?
back 2 3 slides and can you explain the inventory write-off a bit more in detail?
So, Bijal sir,
Just
so that 20% that you're talking about here is essentially the composition of the entire return of the
Can you
value.
go back to that slide so I can understand? Can you explain that slide, please? Because 26 crore inventory also, given the fact that you have reduced your purchasing significantly last year, 26 crore inventory looks on much higher side. It's the next slide, not this one, the next slide. The previous slide, yeah. I don't know what is this. So carrying value is now uh, 2.5 crore.
It's not.
Can you just explain this slide?
Yeah. So 2.5 crores of carrying value is like the write-off value.
Yeah, and that is 20.56%, right?
Correct.
So
Yes.
80% of that, so 4 times of that value, which is around 10 crore, is still sitting in the books, right?
No, no, no. This is a breakup of, let's say, this is a breakup of complete 12 CR that has been written off. Correct?
Mm-hmm.
Okay. Of that complete written off, right? Almost 20% of the written off value was the old generation laptops and
Okay,
desktops. Okay.
okay,
Right.
okay.
And
Mhm.
60% was the spares, which were like 80% of these spares were related to this, right? The old
Okay,
generation laptops and stuff. So it's not like 20% of the overall inventory value. Okay, right now.
okay, okay.
So in terms of value, Vijay, I think right now we have 10 to, I mean, you can like share the sheet in terms of exact quantity, right? Okay. Which we have. I mean, it's just I have to sum that and show, like share, right? Okay.
Yeah, yeah,
Uh,
sure. So, I mean, the larger point is that uh, are you sure that there will, I mean, definitely there is no need. I mean, let's say there is no change in Microsoft's policy. There will not be any further write-off which is required, or still there may be some more write-off which will be coming.
Uh, uh, so, Ashish, can you share the current aging? I mean, if you have off the hand or something.
So I'll just rather, say it louder. So effectively, the current average aging of our inventory is somewhere around 190 to 105 days. So whatsoever the inventory we are holding are more of a higher generation, and include which also includes the spare parts, uh, where the average aging comes at 90 to 105 days across all the inventory.
Okay, okay. Okay, thank you. And in terms of, so how do you see with respect to your sales projection, how do you see, would you be needing more, how much, where the inventory level, I mean, let me put it this way, that where inventory level would be stabilizing, because your revenue has come down significantly. And probably what you were showing is like you are looking at similar run rate for this entire quarter also, April, May, June. So what is the optimum level of inventory you need? Do you even need 26 crores of inventory for that? Because this is looking like more than 1 year's inventory right now.
Right. So, yeah, so this inventory also includes the spares and the components, right? So right now we feel we are in terms of inventory, right? I mean, we can further optimize by maybe another 10-15%, right? But besides that, because I mean, we are expecting like that there is a like a positive trend line in terms of revenue, right? Okay. And at least, like 65 days of like 65 to 90 days, right? Is the turnaround just on the core inventory, and our spare inventory is approximately 25 to 30% of that, right? So I mean, so I do not see us building more on the inventory as such, right? But I mean, uh, we see that maybe there's an opportunity to optimize further by another 10%, 15%, or not more than that as of now.
No, so this inventory, 26 crore kind of inventory, should we see that remaining stable through F27, or it will increase from here? Because our sales have come down so significantly.
Yes, yeah, yeah.
I'm
So
not sure.
so that's what I'm saying, that I do not, as of now, like see that it should increase significantly from here for sure. Okay. We will.
Significantly, I mean, uh,
No, no, yeah, or
so
even increase. Yeah, yeah. I
yeah,
think
okay,
what
that's fine.
we, yeah. So it should not increase in terms of can we further radically reduce it? I do not see an opportunity more than 10% because like whatever like we need to maintain the inventory for the order books as such, right? So
Yeah,
that's
yeah.
what I'm saying. I
So
do not see like further increase.
okay, so 26 crore is the inventory which we should see in 1H of F27 and 2H of F27 balance sheet also.
Yes.
Okay, thank you very much and all the best.
Thank you.
Uh, there is no question. There is no one has raised their hand as of now. If anyone has any question, kindly raise their hand and proceed with your question. Yeah. So Vishesh, I don't see. Okay. So the next question again is coming from Mr. Sachin Sehrawat again. Sachin, kindly unmute yourself and please proceed.
Yes, sir. Yes, sir. Sir, is there any email ID from which we can communicate the management? Because I've been writing mails and I don't get a suitable reply, even on basic questions on ideas which I share with the management.
I'll just ping my email ID if you want.
So you can write to CS, I think also. cs@newjaisa.com.
Or please loop me in as well. I'll just ping my email ID in the chat box. Yeah, Sachin, you can write your suggestions.
Sir,
And
I had written on this mail only, sir.
Ashish at Newjaisa.
Yes, sir.
Okay, okay. I'll see, sir. I'll take a note of it and I'll get back to you on this.
Right. Okay, thank you.
Thank you. Uh, no one is here to
So
ask or raise any certain questions. So we'll
yes,
proceed.
I don't think there are questions.
Yes, no one has raised their hands to raise any questions. Yeah, so we'll just close down our meeting today's proceedings, and I just like to thank you, Vishesh, and all the analysts and investors who have joined us today for the quality of the questions raised. To summarize the key takeaways from today's call, Newjaisa has navigated a year significant challenge restructuring. The Amazon exit, while disruptive, has accelerated our own growth build. Our cost structure has impacted positively with EBITDA turning break even in Feb 26. So this is just for the record. It's a regulated disclaimer, as I stated in the initial starting beginning of the call. This earning call and all material shared in connection with it, including the investors presentation, are governed by Regulation 30 of SEBI and LODR regulations, read with SEBI circular. So this concludes the H2 FY 25-26 earning calls of Newjaisa Technology Limited. On behalf of Mr. Vishesh Hana and the Board of Directors and the entire Newjaisa team, thank you for your time, your continued confidence in the business and your support. Good day. Thank you, everyone.